Hey folks, and welcome back to another video on my YouTube channel. In today's video, we will be going over the ICT silver bullet, and the reasoning for this is that it is a highly requested subject when talking about ICT. Now, I've already published a video regarding this very strategy. However, looking back at it, it was not a very clear, nor was it a high quality video. So in today's video, I will give you the one and only video that you will ever need on the ICT silver bullet. This is a strategy that I always recommend to newer traders or just traders that are not able to spend all day in front of the charts. This strategy is a time-based concept, much like any other ICT concept. However, this one is a little more specific because this strategy has to be executed within very specific times of the day. And you, as the trader, can choose which of the 3 time periods that fits your lifestyle the best. So it goes from 3 to 4 a.m., that's the first time window. From 10 to 11 a.m., that's the second time window. And then from 2 to 3 p.m., that's the third and final time window. Now, this is all done in EST, okay? Whenever I'm referring to a time period, it is EST, okay? These are 3 time periods during any given trading day that you will actively be looking for this setup to appear, okay? And now you might be asking, why is the time important? Well, ICT teaches that the market is coded to an algorithm, and that the algorithm is coded to do certain things at certain times of the day, okay? So through historical data, ICT noticed certain stop runs that occurred during those 3 hours of the day, okay? However, while it's not guaranteed to happen on the pair that you specifically are looking at, it is guaranteed to happen on some pairs every single day. Okay, ICT teaches this. He says that it does in fact happen every single day. But what do we look for, right? Well, firstly, let's establish which pairs you should choose to trade this strategy on. I myself recommend the major currency pairs, such as the Euro USD, the GBP USD, gold, and AUD USD. Those are some of the biggest and most traded currencies around the world, and I would stick to those. And as for futures traders, like myself, stick to the E-mini Nasdaq 100 and the E-mini S&P 500. Step number 2, locate a liquidity sweep before or during the silver bullet hour. But what does this mean, right? If we take a look at my screen right now, I have drawn out 2 points of buy-side liquidity. And the line, black line right here, represents the 3 a.m. mark, which is the start of the first silver bullet hour, okay? So as you can see, in this example, let's say that right here was the 4 a.m. mark, right? 4 a.m. That'll be right here, right? So everything has to happen between these two lines, right? Because that is the silver bullet hour. And as you can see in this example, we get our liquidity sweep after 3 a.m., right? As you can see, we sweep these 2 relative equal highs after 3 a.m. And that is fine. However, on the other example over here, we have buy-side liquidity that gets swept before the 3 a.m. mark, and that is also fine, right? So you just have to establish a run on liquidity before or during the silver bullet hour. Step number 3, look for a market structure shift to take place after the liquidity sweep has happened. So what is a market structure shift? A market structure shift is a candle closure below the most recent swing high or swing low. So if the candle that is in between two candles wicked higher than those two, we would classify that as a swing high. Same for the swing low. If the candle in the middle of two candles wicked lower than both of those two, we would classify that as a swing low. So if we take a look at my screen right now, we have a swing low right here because this wick is lower than this wick and this wick. So that would be a swing low. Had it looked like this would not be a swing low. This would now be the swing low because this is lower than this and this, right? So swing lows and swing highs are a three candle pattern, right? You need three candles in order to classify it as a swing low because it has to be lower than the two candles next to it. So when we get a candle closure below that, as we get right here, we would classify that as a market structure shift. Okay, this does not have to be bearish. This could be bullish and still be a swing low, and that will still be a bearish market structure shift. Now notice how I wrote optional, and that is because the market structure shift is not necessary for the silver bullet to work. However, it does make it a higher probability trade. Okay. Now there are certain times where you would get the exact setup you're looking for, but you're missing a market structure shift. That, in my opinion, is still a perfectly fine trade to enter. Just know that if it had a market structure shift, it would be a higher probability trade. So if you don't get a market structure shift, you can still enter the trade, but I would use lower leverage. Okay. Step number 4, find a 1 to 5 minute fair value gap. So if you don't know what a fair value gap is, it is a 3 candlestick pattern. So a bullish fair value gap is the space in between the top of the first candlestick and the bottom of the third candlestick, right? If we look at my screen right now, the top of the first candlestick would be this. This is with wicks included. So the top of it is this right here. And the bottom of the third candle is this right here. The space in between is what we classify as a fair value gap or an inefficiency. Had it looked like this, right? There would be no space in between, and therefore it would not be a fair value gap, right? And in a bearish example, exact same thing. A bearish fair value gap is the space between the bottom of the first candle and the top of the third candle. This space in between is what we classify as a bearish fair value gap. And again, had it looked like this, there would be no space in between, and therefore we could not classify it as a fair value gap, right? I have a more dedicated video towards the fair value gap, if that is of any interest. But you want to find ideally a 5-minute fair value gap to form after the liquidity sweep in the opposite direction. Okay. Note that ICT did do the silver bullet trades on lower time frames. That is why I said the 1 to 5 minute. But most of the time, and a lot of people teach that you should only look at the 5 minute. I just want to include that he also uses the silver bullet model on lower time frames. This can be seen in his evolving silver bullet video. However, I recommend to stick to the 5-minute time frame, especially for newer traders. Okay. So if the liquidity run that happened was on buy side liquidity, you would look for a bearish fair value gap. And if the liquidity run that happened was on sell side liquidity, you would look for a bullish fair value gap. Step 5, target and stop placement. So for a bullish silver bullet, you should set your stop loss at the recent low and target a 1 to 2. Okay. Or what you could do for better risk to reward is either place your stop at this low right here of the fair value gap or this low right here of the fair value gap, right? If there's a low further down, maybe there was a low down here, right? You could also place your stop here. However, that would, make it worse RR or make it a longer trade. And then you would target a 1 to 2. So it would look like this. You would place your entry off of this fair value gap right here. Maybe your stop here. And then a 1 to 2 risk to reward, which would be this right here, right? Some people teach it's different. I find that it has the highest win rate when targeting 1 to 2s. You could also target opposing liquidity or just obvious points or pools of liquidity. That is completely up to you. I'm just teaching what I have found to be the highest win rate, which is a 1 to 2 risk to reward. Important note, your entry must take place within the silver bullet hour. If your order is not filled within that hour, you close the order and move on, okay? However, you can leave your trade running outside of the 1 hour time window. It is just your entry that has to be executed within that 1 hour time window. So if you place a trade at 3:45 and it hits TP at 4:45, that is fine, but you cannot place your entry after 4 a.m. or after 11 a.m. or after 3 p.m. Okay? So let's look at a few examples of a real chart. So right here we are on the TPP USD, and the first red line represents the 3 a.m. mark, and the second red line represents the 4 a.m. mark. So our entry has to take place between these two red lines, okay? And as you can see, right before the silver bullet hour, we swept buy side liquidity. And if we play it out, right? We wait for a fair value gap to form, which happens right here. And we have a market structure shift that happened here, right? Because we get a candle closure below this wick, which is lower than the wick next to it and the other wick next to it. So this would be a market structure shift. And there is also a fair value gap in between that right here. So you would place your limit order here with your stop above the high right here, targeting a 1 to 2. That would look like this. And we get filled on the next candle, and that is still in between the 3 a.m. and 4 a.m. mark, right? And then, as you can see, we hit TP, but notice how we hit TP at 4:35. That is fine because our entry was before 4 a.m., right? Our entry was at 3:50, which is fine. Let's look at another example. So this is the AUD-USD pair. And as you can see, now we swept buy side liquidity inside the 1 hour silver bullet time frame, right? Before it happened before the hour, now it happened after the hour, right? So we wait for a fair value gap, which we get right here, right? So we place our limit order here. Now keep in mind, because this happened at 14:55, we have to get filled on this next candle. Otherwise, we cancel our limit order, right? We target a 1 to 2 right here. And we do, in fact, get filled. So we play it out. And we hit TP, right? Keep in mind that these examples are in hindsight. All of your results are not going to look like this. But this was just a fine example. Look again how we hit TP after the 3 p.m. mark. So after the silver bullet hour, but that is fine because we got filled before we exited the 3 p.m. mark, right? So let's look at another example. And here we are on the Euro USD. And as you can see, right before 10 a.m., we sweep buy side liquidity. And then we would wait for a fair value gap to form, which we get right here, right? Notice how this setup does not have a market structure shift included. As I said, it is optional when we have a big displacement candle like this after a liquidity sweep. That is fine enough for me. So I place my stop above this high here. You could also choose this high. I prefer this one. Then I target a 1 to 2. We get filled here on this very candle. And as you can see, TP hit again. Outside of the 11 a.m. mark, that is fine. We just need the entry to happen between these two lines, right? Within that hour. So let's look at a final example. Here we are on the E-mini S&P 500, the December contract. So right on the dot at 3 a.m., we get a sell side liquidity sweep. So I would look for a bullish fair value gap, right? Which we get right here. And in this case, we also get a market structure shift here because we break this swing high. Why is it a swing high? Because the wick of the middle candle is higher than both of the wicks next to it, right? Had it looked like this, this would not be a swing high. This would now be the swing high, right? So we get a market structure shift, right? And we get a fair value gap right here. Then we get filled and we target I'll stop being below these relative equal lows here, targeting a 1 to 2. There we go. And there we go. This was all I have for you today on the ICT Silver Bullet. Keep in mind that these examples are in hindsight. Do not expect all your results to go like this. This is purely to show you what a perfectly executed ICT Silver Bullet looks like. Keep in mind that your psychology is a very, very big factor when trading. But if you stick to the rules that I provided you with, you will, without a doubt, see some changes in your trading. This is all you need to become profitable. All you have to do is follow these rules, okay? A lot of people seem to think that they have to be placing trades all the time in order to improve, right? In order to feel like they're working actively. But that is very, very wrong, right? Some of the best traders I know trade 1 to 2 times a week, okay? With this setup, you get the opportunity to trade 3 times a day. Now, in reality, you only need 1 or 2 trades a week, right? So find the pairs that you want to trade this on. Look for this to happen between 3 to 4 a.m., 10 to 11 a.m., and 2 to 3 p.m. If you don't get a setup, close your chart and come back tomorrow. That's the beauty about trading. The market brings new opportunities every single day, okay? So focus on these 3 time windows, and I promise this is all you need to become profitable, okay? I hope you enjoyed, and I hope this video was a little bit more clear and better than my last one. I made a second video on the Silver Bullet because I feel like this is such a great setup, especially for aspiring traders who are not full-time yet and do not have time to sit in front of the charts all day. This gives you a very strict time schedule of when you need to be actively looking at the charts, which is great for people who are working a job, having kids, you know, whatever it might be. So I would highly recommend this strategy to anyone, but the rules have to be followed, just like on any other strategy. So I hope you enjoyed. If you did, leave a comment down below. If you didn't, leave a comment down below. And until I see you next time, stay blessed and bye-bye.